Imagine the busiest highway on Earth, a highway so vital that nearly a quarter of the world's daily oil supply flows down it. Now, imagine that highway is completely empty, not a single truck, not a single car, just the sound of the wind. That is exactly what is happening right now in the Strait of Hormuz. For the last 2 weeks, this narrow strip of water between Iran and Oman has turned into a ghost road. The usual convoy of supertankers? Gone. According to the United Nations, ship traffic through the strait has dropped by an astonishing 97%. Welcome back to Finn About Money. I'm Finn. Today, we aren't just talking about a geopolitical conflict. We are talking about the economic equivalent of a heart attack. Iran has effectively choked the world's most important energy artery. And as your gas station prices creep up and your portfolio gets shaky, one question is on every trader's mind. Are we really about to see $200 a barrel oil? Let's break down what is actually happening in the water, what happens next, and what it means for your money. To understand why this is such a big deal, we have to look at a map. The Strait of Hormuz connects the Persian Gulf with the open ocean. On one side, Iran. On the other, the UAE and Oman. At its narrowest point, it is only 33 kilometers wide. But here is the kicker. The actual shipping lanes, the deep water channels where these massive tankers can safely sail, are only 2 kilometers wide in each direction. 2 kilometers. Now imagine trying to navigate a ship the length of 3 football fields through a 2-kilometer lane while knowing that Iran's Revolutionary Guard Corps has declared that any vessel destined for the US or Israel is a legitimate target. On March 2nd, an advisor to the commander of Iran's Revolutionary Guards announced the strait was closed. And it's not just talk. The UK Maritime Trade Operations has reported multiple commercial vessels hit by unknown projectiles. Drones and missiles are flying. At least 8 mariners have been killed in these attacks. The result? It's a de facto blockade. As one analyst from Global Risk Management put it, you can risk attack and you might not get insurance, so you have to wait until the security situation gets better. No captain is willing to sail their multi-million-dollar ship and crew into a war zone unless they have a Navy escort. And right now, despite President Trump's promises, the US Navy has deemed it too dangerous to start escorting tankers just yet. So the highway is closed. What is the actual damage? Under normal conditions, about 20 million barrels of oil pass through the strait every single day. That is roughly $600 billion worth of energy every year. But now, that flow has been cut off. We aren't just talking about Iranian oil. We're talking about oil from Saudi Arabia, Iraq, Kuwait, Qatar, and the UAE. These countries are the heavyweights of OPEC, and because they can't load their oil onto tankers, they have to pump it into storage. And now, those storage tanks are full. According to a new analysis from Wood Mackenzie, a leading energy consultancy, the global market is now facing a supply gap of roughly 15 million barrels per day. To put that in perspective, that is more than the entire daily oil consumption of China. We have never seen a disruption on this scale. This is why the International Energy Agency is planning to authorize the largest release of emergency oil reserves in its history, 400 million barrels. But here's the math problem. Even if that release happens, it covers less than a month of the shortfall. It's a band-aid on a bullet wound. We saw oil prices spike to nearly $120 a barrel on the first Monday of the crisis, before settling back to around the $90 to $100 range. But the smart money isn't looking at today's price. They are looking at the trajectory. And this is where we get to the title of our video. Olivier Blanchard. You need to know that name. He is a professor emeritus at MIT and a former chief economist at the International Monetary Fund. This is not some random crypto bro making predictions. This is the Macroeconomics Authority. On March 12th, Blanchard went on record saying that given the supply shortage, prices should be closer to $150 or $200 a barrel, or even higher. His logic is simple. The market can no longer rely on what he calls the taco trade Trump always caves on. In the past, markets assumed Trump would ultimately de-escalate to protect the economy. But in this conflict, he cannot unilaterally decide how it ends. Iran has no reason to stop shooting at tankers just because the US wants them to. The head analyst at Wood Mackenzie agrees. He noted that while we saw $150 oil during the Russia-Ukraine crisis, this situation is actually much bigger and more dangerous because it hits the heart of Gulf supply. Let me read you a quote. This is from Amin Nasser, the CEO of Saudi Aramco, the most powerful oil company in the world. He said a prolonged closure of the strait could lead to, and I quote, catastrophic consequences for global oil markets. Why such strong language? Because the world has no spare capacity. For years, oil companies have underinvested in new production. Global oil inventories are already at their lowest level in 5 years. There is no extra tap to turn on. The US could try to ramp up drilling, but that would add only a tiny fraction of what's been lost. The impact is being felt most acutely in Asia. China, India, Japan, and South Korea are the biggest customers for this oil. China alone buys about 90% of the oil Iran exports. These countries are now scrambling. They are hunting for oil from West Africa and Latin America, creating a global bidding war that pushes prices up for everyone, including us here in the West. We are already seeing the knock-on effects. Bangladesh has shut universities to conserve power and fuel. South Korea has announced price caps on fuel for the first time in 30 years. India has ordered refineries to boost LPG production because of supply disruptions. The dominoes are starting to fall. So what is the US doing about it? President Trump has promised to use the US Navy to escort tankers, calling it gunboat diplomacy. He's even boasted of destroying Iran's navy and clearing their mines. But naval experts are deeply skeptical. Sal Mercogliano, a maritime shipping expert at Campbell University, points out that we are facing a problem of asymmetrical warfare. The US has massive, expensive aircraft carriers and destroyers. Iran has small, fast speedboats armed with missiles and land-based anti-ship cruise missiles. But the biggest threat? Mines. Retired Canadian Vice Admiral Mark Norman warns that Iran likely laid mines in the strait before the conflict even started, programmed to detonate remotely or on contact. These mines are cheap. In 1988, a mine that cost Iran about $1,500 hit the USS Samuel Roberts frigate and caused $96 million in damage. If a tanker, or worse, a US destroyer, hits a mine in a 2-kilometer wide shipping lane, that ship could sink and block the entire waterway for weeks. As of now, despite political promises, the US Navy is not escorting tankers because the risk is too high. And even if they start, there is no military solution to this without putting troops on both sides of the strait. Experts suggest the only real fix is a diplomatic agreement. I want to pause here for a reality check because some of you might be thinking, Finn, oil prices dipped below $90 the other day. Maybe this is blowing over. That dip was driven by comments from President Trump hinting the war was, quote, ahead of schedule, and tweets about destroying Iranian mines. But the physical reality on the water hasn't changed. The ships aren't moving, and even if a ceasefire happened tomorrow, the energy crisis isn't over. Shut-in oil wells can take weeks or months to restart. Refineries that have been damaged, like Bahrain's Sitra refinery or Saudi Arabia's Ras Tanura facility, need repairs. LNG plants in Qatar take weeks to ramp up from a total shutdown. While we wait, the costs are filtering into everything. The UN warns that this disrupts not just oil, but the fertilizer trade, about 16 million tons of it annually. That means farmers facing higher costs, which means higher food prices for you and me by the end of the year. Shipping costs have already exploded. The cost to hire a supertanker from the Middle East to China has nearly doubled to a record $400,000 a day. Those costs always get passed down to the consumer. So back to our question, is a $200 oil barrel coming? If the Strait of Hormuz remains functionally closed for another month, if that 15 million barrel a day hole remains open, then yes, $150 to $200 oil is not just possible, it's probable. At those levels, we are talking about a serious recessionary shock. It's a tax on everyone who drives a car, flies on a plane, or turns on the lights. For your money, this means one thing: volatility. We are going to see wild swings in the market based on every tweet, every missile launch, and every diplomatic rumor. Keep an eye on the shipping news. Watch what the IEA does with those strategic reserves. But most importantly, understand that we have entered a new phase where energy security is no longer guaranteed. The days of cheap, abundant oil from the Gulf are, for now, on hold. I'll be keeping a close watch on this for you. Thanks for watching Finn About Money. If you found this breakdown helpful, hit that like button, subscribe, and I'll see you in the next video.